The Property Pod. Welcome to The Property Pod with Moneyweb. The property sector is an ever-changing sector, and in this podcast series, your host Suren Naidu chats to movers and shakers in the property industry.
Hello and welcome to The Property Pod, South Africa's premier property investor podcast. My name is Suren Naidu, and on this weekly show, we gain insider insights from leading CEOs, analysts, developers and entrepreneurs in SA's expansive property industry. We have covered the listed property sector and its 2023 performance a bit on Moneyweb in the last 2 months, but with the SA REIT conference taking place in Johannesburg last week, we caught up with Estienne de Klerk, the chairperson of the SA REIT Association and SA CEO of Growthpoint Properties, to talk us through some of the hot topics and issues discussed at the conference. For a little clarity for our listeners that are not property investors, SA REIT stands for the SA Real Estate Investment Trust Association. Estienne, the last time I spoke to you on this podcast was 2 years ago, believe it or not, back in February 2022. Welcome to the podcast.
Hi, sir, and thank you for having me.
At the SA REIT conference, MC Michael Avery kicked it off joking the listed property sector has been in the dog box in recent years. Is the sector still in the dog box?
I think we are emerging out of the dog box, Suren. I mean, if you were an investor last year in REITs, you would have been rewarded with the best performance of all investment classes across the year. So, albeit marginal, it was, number one's number one. So I think the reality is that fundamentally we're starting to see, the real estate metrics improve. From the days of COVID, and really the only little dark cloud that's a real issue at the moment, or remains a bit of an issue, is obviously higher interest rates is still having an impact on income statements of the REITs.
We'll get to interest rates in a minute, but you are chairperson of the SA REIT Association in addition to your position as SA CEO of Growthpoint Properties. What were some of the key issues and messages to come out from the REIT conference?
Yes, sir. And I think we've opened up where there were a whole bunch of CEOs on a panel which sort of set the scene. They covered some of the metrics within the real estate REITs as we have experienced it over the past year, and their views on going forward through the year, and impacts of things as wide as maybe the changes in technology, etc. were sort of discussed. And then post that we got a bit of a global view on the economy globally and some of the things that may impact real estate in South Africa, because as you're well aware, the South African economy is integrally linked into the world economy, and albeit that we're a little tiny player in the scheme of things, whatever happens globally ultimately has an impact on the SA economy, which in turn has a real impact on SA REIT members or real estate in South Africa. So I think that certainly was discussed in detail. And then we have also had discussions, because one of the key challenges in our sector is obviously municipalities and, let's say, government policy, etc. And we had Wayne Divenage from Outer come and talk to us a little bit about some of the successes they have had in holding government and local government to account, in ensuring that our tax money is spent wisely, and that it actually makes the difference and delivers the services that we're paying for. And then through the day, there will be various speakers. We had a look at the performances of real estate globally. The context is quite interesting that, if you look at real estate globally, the experience has actually been very, very similar to what we are experiencing in South Africa, and sometimes for different reasons. But certainly, we're not alone, and in this context sort of, gives you certainly some comfort that there's there's some consistency with global markets in the South African context. And, we've had some institutional investors and analysts give their views on the sector and the way forward. And then through the day, we'll be discussing ESG. We'll be discussing a variety of items that are really relevant and key issues in respect of real estate, even including things like property tech, etc. So a very exciting agenda for the day.
It was indeed a very interesting panel chat by Wayne from Outer. I was in that session, very provocative, interesting things to hear from a municipal service delivery perspective. On one of the panels, you were one of the speakers. You talked a little bit about Regulation 28 and pension fund changes and its impact on REITs. Can you talk us through a little bit of what you mentioned, considering REITs are underweight currently in terms of asset manager allocations?
Yeah. So maybe just sort of big picture, just to for your listeners to understand how investment flows effectively work in the world, is that generally most of the investment funds flow from our salaries into pension funds, and those pension funds have managers, and they typically either have investment managers themselves or award the capital to investment managers via mandates all across the globe, right? And they would then get advisors which say to them, look, we think interest rates are going to go up and the real estate sector is going to struggle. So we want you to reduce, or we propose you reduce your exposure to real estate in the specific cycle. Now, typically, you could find in some of the developed markets that the exposure to real estate will be as high as 10%. It is arguably the largest sector on the planet, the biggest industry. And in this cycle that we are in, where interest rates have certainly gone up, I think many pension fund advisors as well, many of the pension fund managers have sort of taken the view that the cycle is pretty negative for real estate broadly, and as such they have reduced their exposure by physically selling. But it's also, as share prices have dropped, by itself, that percentage has dropped. So, today, at the peak of the cycle in the JSE, I would say asset allocation to real estate would have been about 6%. That has reduced to around 3% And I think what Regulation 28 has done, and just for listeners to understand, in these pension funds in South Africa, they actually are limited in terms of their ability to invest capital offshore. So they were limited to only 30% of the funds being invested offshore. And then surprisingly last year, out of the blue, that regulation was lifted to 45%. So that meant additional 50% more investment offshore, if you'd like, because they added another 15% onto the existing mandate. So what was actually happening was that investors were selling local equities, real estate, and investments, and they were moving that capital offshore. And we saw quite a significant outflow of capital out of the JSE across the board, not just real estate, but into international markets. And what we are also sort of hearing along the grapevine is that some of the local pension funds are actually awarding mandates to offshore asset managers rather than seek some of that exposure through the local market, And that means that capital probably may be more permanently offshore. But as this goes into the base, so in other words, when you're at 45, then you sort of have to start investing back into South Africa again in the ordinary course, 60% of your capital. And some of that will find its way into real estate. And increasingly, if the real estate industry can demonstrate growth in earnings and potentially good returns, then, I think we'll start seeing a larger lion's share of that capital, and that will ultimately, help to drive share prices.
Thanks for that, especially the mentioning the 45%, because that was the key aspect of your point on that panel. Estienne, turning to interest rates now, Nedbank's head of property said the bank expects SA interest rates to drop by around 100 basis points this year, more towards the latter part of the year. Considering your comments around interest rate, what impact is this likely to have on the SA REIT sector? considering also that it may take some time to filter through?
So I think just the messaging that interest rates will drop will be enough to see quite a bit of a rebound on the stock exchange, actually pretty much across all asset classes, including real estate, but more specifically real estate, because properties shares, given the fact that they pay a distribution gross to investors, they're very much a yield play, and as interest rates go down, the yield requirement drops, share prices increase. So what we would expect is that just the messaging that interest rates will drop will already certainly benefit the underlying stocks as investments, but on top of that, I think that most of the companies have debt on balance sheet. And over time, as interest rates come down, they will benefit increasingly from those lower interest rates. So similar to how they, at the moment, are having to manage with higher interest rates, and that's obviously having a negative impact on the income statements. A reduction in interest rates will have a positive impact on the income statements, which means bigger distributions to investors.
The big question was, it's a topical issue whenever I speak to a REIT CEO, but the big question also at the conference was around SA REITs trading at a discount to net asset values. 10 years ago, the sector was trading at a premium, I believe. What needs to get the sector back into possibly trading at a premium? Is that possible in the next 5 to 10 years?
Yeah, so I think, Suren, the fundamentals are really a couple of key things. I think one is investors want to be able to see growth in distributions. Obviously, when we were trading at a premium to distribution to the actual underlying asset value, that was times when interest rates were very low. You had a very strong growing economy, rentals were going up, vacancies were low and coming down. So, the moons had sort of perfectly aligned, which sort of resulted in that sort of dynamic. The reality is that in this environment, interest rates are now still, they've now stabilized. So I think that what you'll find over the next 1 or 2 years, that will still flush through the earnings of REITs. But then after that, I think, you should start seeing the benefits of lower interest rates. So that's a key. I think one key thing is interest rates reducing. We'll see stocks trading much closer to NAV. And then, growth. If you can demonstrate growth in earnings, underlying distributions, those will, and there's a myriad of things that will drive that. Obviously, reduction in costs or increase in rental income, reduction in vacancies, more demand, and potentially accretive M&A transactions. All those type of things can result in, the share prices trading either closer or even at a premium to NAV. So if you think about the share price, when you look at the NAV underlying, the actual valuation of the assets underlying shouldn't, if you add them all together, doesn't necessarily result in exactly the same traded value on the JSE. And the reason is that there's a whole bunch of other metrics, for instance, debt and interest rates that come into play, and growth factors that come into play into that valuation of the actual stock that's traded. And if you think about REITs, it is the most liquid and tradable way to acquire real estate in this country. It's also the cheapest way in terms of costs. It gives you the biggest diversification. It gives the individual investor ability to get exposure to the best quality properties available in the country. And, if you think about it, there's also quite a component of international exposure in many of the stocks today, which also diversifies the investor, out of the South African economy, as an example. And on top of that, you're getting probably a cheaper level of capital funding those investments, because most of these companies can attract cheaper capital than individual investors can, and they have dedicated management. So it's, if you had to buy your own property, whatever it is, you have to worry about fixing the bathrooms and the toilets and the things and making sure the property is well managed. Whereas if you invest in a REIT, it's certainly admin light, relatively, and you should get, certainly our research shows that on average, a REIT portfolio of REIT shares outperforms underlying direct investment into real estate.
Just to conclude, Estienne, I know Growthpoint is in a close period at the moment. Your results are coming out in March. But one of the other things talked about is that capital raising is quite difficult in the current environment for REITs. In addition, there's been hardly any new listings in the REIT space in South Africa, and I suppose globally to some extent as well. When can we expect this to change? And I ask this because your fund's management model as Growthpoint, a few years back when you started the health fund and now the student accommodation fund, you talked about possibly listing those separately at some stage.
Yeah, so Suriname that's a much more company-specific sort of question. For Growthpoint, I mean, we have built this fund management business which uniquely offers investors opportunity to unlisted REITs, which is pretty unique, and really the opportunity to get very specific niche exposure, as you mentioned, to healthcare and student accommodation. And I think, ultimately it's the investor's call, but the idea was that, that a liquidity event would be on the cards for those investors in 5 to 7 years. And that IPO probably would have been the right way to go about it. Now, that is pretty cycle dependent, and I think we do think that the cycle is improving, and that opportunity for those companies to IPO in the future certainly is still there.
Estienne, I appreciate your time speaking to us during the lunch breaks. I hope you can get some lunch at the SA REIT conference. That was Estienne de Klerk, chairperson of the SA REIT Association and SA CEO of Growthpoint Properties.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.